Hello, everyone, and welcome to the Stanford Brown SB Talks podcast. Today is Monday, September 13th, and we're catching up once more with our Chief Investment Officer, Ashley Owen, to talk various elements of the investment outlook, but primarily on reporting season reflections and the longest run for shares since World War II. Welcome, Ashley.
Welcome, Vinny, and everyone out there, wherever you are in the world. Good evening, good night, good morning.
Thank you. So, Ashley, another reporting season behind us, and company profits continue their rebounds.
Yes, the big news for August was the fact that profits in Australia have come back or are well on track, or in fact ahead of target to rebound to their pre-COVID levels. You'll recall we've been tracking this for about a year and a half now, where you have global profits, because ultimately share prices are a reflection of profits or profit expectations. So if profits collapse and the share price collapse, then share prices have been rebounding strongly only because profits have been forecast to rebound strongly, even though you've still been lockdowns around the world and you've still got economic contractions. I think UK had a flat quarter, Canada's back in recession, the US is probably back in recession, Australia's probably in recession right now with all the lockdowns. So even though those things are going on, share prices have been rebounding strongly. They've doubled in the last year and a half since COVID, because profit expectations have been that profits will return to their pre-COVID levels, even though the world is still in a hole.
Very much looking through the short term. Yeah,
so that's right. So share prices are based on outlooks for the future, not on what's in the past. So up until August in Australia, we have the August reporting season and a February reporting season for the two half years. They're the two big reporting periods for almost all companies. In the US, we've got a much smoother quarterly cycle. All companies report quarterly, so July is the big reporting season for the June quarter. Plus, we had another one in April for the March quarter. So already in the US is 60% of global profits and global share values. So already in the US market in total, and now the global profit picture in around the world is 30, 40, 50,000 listed companies in the world, most of which are US value. They've now recovered their entire losses and profits reductions last year. So US and global profits are now on a par with what they were pre-COVID, which is extraordinary because the world is still in lockdown. There's a lot of reasons for that with the stimulus payments.
I was going to say, when you look through it, that's built on such solid footings.
It is. Well, we'll talk about globally in a second. In Australia, which is the August reporting season just gone. Back to global for a second. The question is it on solid footing? The world companies in 2019 made $3 trillion of net profits, reported profits. In 2020, with the COVID recessions, that dropped to 1.7 trillion. So 1.1-ish, $2 trillion fell out, disappeared in the COVID recession. And already, even though we're still in lockdown, global profits are running at a 12-month average of $3 trillion just reported in July. So the pre-COVID profit levels, boom time profit levels, have been completely restored. Plus also companies are reporting profit increases over the next year. So
more surprises on the upside than the downside.
Yeah, and I look at quarterly profits in the US, and this time around I had to upgrade the profit outlook for 88% of companies, which is 9 companies out of 10, even though they're bullish forecasts for increased profits next year. I do upgrade them because they keep beating their forecasts. And 88% of companies, the only companies that were down were Procter & Gamble and Boeing and a few healthcare stocks, because hospitals are still closed. So apart from that, every other company in the world, in my universe, has increased its profit outlooks based on beating its estimates already. So is it reasonable? And the answer is, even though you'd think that we should still be in a profit recession, even though we haven't returned to economic activity like we have last year, half of the profits really aren't cyclical. They're not affected by the lockdowns. A lot of companies, the Apples, Googles, Microsofts, Amazons, all of those boomed through the lockdown period. And they increased there. So the Amazoning of retail accelerated. So a lot of companies, a lot of retailers, which were, I think like JB had a very poor online presence before COVID. That was a very good retail store on the ground. They had they were behind the 8 ball on online delivery. Surprising as it seemed for JB. They changed their entire operation in weeks, and they became one of the leaders. Same with Harvey Norman. Harvey Norman peaked in the 80s and 90s. It's been dead for 20 years. All of a sudden, their management now have switched on very quickly and did a very good job of accelerating their sales. So Harvey Norman are one of the leaders of the online revolution, but they were really behind the 8 ball up to then. Things like Reese Plumbing, which is you buy your taps and bathroom plumbing supplies at Reese Plumbing. They absolutely slaughtered it in the US because they were the fastest to move online in the US renovation boom. And they're an Australian Aussie company, a simple Aussie company listed in the ASX. So a lot of companies did very well, even old-fashioned bathroom supply companies and tap companies that don't sell online. They did extraordinarily well in the COVID. So about half the profits in this global $3 trillion pie of profits were from companies that actually weren't affected. And if they were affected, they were positively affected by the COVID lockdown. So that explains why the $3 trillion of profits now is already in the bank. And now we're looking at probably another $500 billion increased profits in 2022 over and above the record profits this year. So that's just the global picture. Looks pretty good. They've already filled the hole in profits. Dividends will come back because dividends follow profits. And it looks pretty good for share prices, which means there's a good underpinning of the share prices have doubled because profits have more than doubled over the last year. So it's on fairly solid ground. Now, that doesn't mean they're not expensive. They're still expensive on a whole range of metrics. So they're still, in 10 years' time, you're not going to get 10, 12% returns compound every year. You're going to get single-digit returns from global shares. But so far they're drifting up, and there's got to be a massive trigger. And we'll get to what might trigger that in a few minutes' time. Before we do that, the other part of the question is the Australian reporting season. Now, Australia is slower to report because it's only got 2 half years, and their accounting rules are very different, and what they report in the half years is quite different to what they report in the full years. Whereas the quarterly reports in the US are pretty much full set of accounts for each quarter. In Australia, in August, we had the reporting season for the half year. Most companies in Australia have the June full year, so we saw the full year results. Some big companies, like 3 of the big 4 banks, report in September. So we got sort of half-baked quarterly numbers, which look pretty good. CommBank reported for the full year. Their profit year was down, year on year for last year because of their CommBank peak 5 years ago. It's hit $100, but the actual engine of growth in all the banks, including CommBank, hasn't been the same since the last 5 years ago. Because Hayne and all the problems it's got and selling off the assets and all the fines and money laundering and market rigging and all sorts of things they've done. All banks, not just CommBank. So their profit was flat for the year. The big story that I covered in the report was the fact that in Australia we had 2019 profits for about $100 billion net profit after tax, 2019 pre-COVID. That fell to $30-odd billion, i.e. a drop of 60 to 2/3 of profits disappeared last year, which is a bigger disappearance than the global profits. Banks produced big profit cuts. Oil and gas produced their regular losses. Things like retailers, things like listed property trusts all wrote off tens of billions of dollars. So we had this massive collapse of about $60 billion in profit. So the question is, share prices have driven back up very strongly since this time a year and a half ago, since the COVID crisis. So the big question was, how do the profits look? Have they recovered like the rest of the world's profits have recovered? And basically 3 companies accounted for pretty much the entire $20 billion profit jump, and they were Fortescue, BHP and Rio, based purely on iron ore revenues.
An absolute iron ore bonanza. So
the bonanza. So the iron ore bonanza has, so the short answer to the question is the Australian profit story is well on track to produce its pre-COVID profits by the end of the year, which is what this magical star on the horizon said we would do. It's on track to do that. The 3 big banks will report in November, early November. They report their full year results, and I expect them to be pretty good because they've written back bad debts they didn't need to use. They've got lower costs than they thought they had. So the banks, plus also you've got a few companies that most of the oil and gas stocks report in December. So we'll see those. Hopefully they can stop losing money. Most of the oil and gas losses basically are own goals, just stupid things they've done. Oil prices have gone from negative back to $70-odd. So there's no excuse. Oil and gas companies around the world are making profits again. Our guys discover ways.
Writing off various failed projects.
They're always buying at the top of the boom. They always spend too much and they always write it off. So AGL is an oil and gas stock for their purpose as well. So anyway, the good news is the Australian profit history story is on track to rebound back to pre-COVID levels, which is good, which underpins the share price growth we've had over the last year and a half since the sell-off in March last year. So far, so good.
Can I just, when we're talking then, you touched on it before, and let's talk to it while it's topical. Obviously, the iron ore boom, there've been constraints in global supply due to COVID and other natural disasters, or not even natural disasters in Brazil.
Yes.
Now, China has been increasingly in recent years, and definitely in recent months, flexing its nationalisation muscle, and seen that particularly around the education space, but also potential question marks what's going to happen to demand for steel and what that might mean for iron ore. So should investors be concerned about what they're seeing here?
Well, the first thing to say is that all of us, including the federal budget and all the state budgets, we all assumed the iron ore price was $20 odd, $30 odd this time a year and a half ago. Then we had all the budget sessions and the May budget and the emergency budgets and the half-yearly budget. They all were based on iron ore prices of at best for 40, 50, 60, somewhere outlandishly positive, and said, well, what if we get $80 a tonne for iron ore? It shot up to $135 3 or 4 months ago. All of it was well above those levels, the budget levels. So all the mining companies budgeted on those. It was an absolute boom time profits from the 3 iron ore majors, plus all the smaller guys as well, but really the iron ore majors. It was, so the point to make is, first of all, it was well above anybody's wildest dreams. So the fact that it's now off 40% is still double what we always thought it was a year and a half ago. So it's still a boom. It's a question of where your reference point. If your reference point is $130, $230, it's sitting at 130 odd today. That's a big drop, but relative to what we all thought it would be, it's still above. So yes, the $20 odd billion increase in dividends now was a $20 billion increase in dividends over this half year last year, about sort of $30 billion in total. So you're talking a lot of money hitting bank accounts for a lot of shareholders around Australia. That's in the bank. Will it repeat next year? We always thought no, because we always thought this was just a fantastic windfall profit, one of those once in a lifetime things. Got it, put it in the bank. It won't get there again for a while because cyclical, these things are changing. So the reason for this, the price of anything, jelly beans, chocolate, cars, iron ore, is basically a function of demand for the product and supply. Now, most commodities, the investors think about the demand. You know, China's growing, people are using more things, people are building batteries for cars and electronic vehicles, and all these things create demand. The demand for commodities is fairly well understood. We know the world is growing, we know the wealth is growing, we know the use of materials is growing. Most of that is really well understood and in the bank. What people tend to ignore is the supply side of commodities. So commodities work in a very similar supply cycle, because an oil and gas is the same, metals are the same, coal's the same. It takes years and years and years of exploration, development, building a mine, drilling 1,000 holes. It takes years.
Huge lead time to get the production there.
10-ish lead time to actually say, right, we're going to need to, they're going to look for nickel or cadmium or lithium or iron or whatever, because there's demand for it. So 10 years later, they're still now bringing that new mine to production. So the iron ore price boom we've had over the last, ignoring the blip last year, the iron ore boom we've had post-2003, which is the start of the China industrialization boom, that's created a massive price in all commodities, including iron ore. But that then collapsed in a hole in the GFC. The post-GFC stimulus drove it up again to peak again in about 2011. There was a slowdown again to 2015, and the 2016 stimulus drove it up again. Then we had the COVID. So it's been very high, given some ups and downs. So a lot of mining companies, all the majors included, said, right, we're going to go and explore more new stuff. So on the supply side, there are now quite a few additional mines that are now coming into production, like Roy Hill, like Gina Riley's mines. They will, and a lot of mines in Africa, particularly West Africa, a lot of mines are now coming on stream, or will come on stream, what was started 5-6 years ago to develop and to explore. That will naturally depress the price, or put a depressing...
put more supply into, and therefore drive the price down the curve.
So Meanwhile, that's the thing that we're watching closely as new mines come on. The big three produce around about 250 million tonnes of rock per year, except Rio produces about 330 billion tonnes of rock, million tonnes of rock. So together, Australia exports around about 900 million tonnes of rock, of iron ore rock, to China. Now, that hasn't changed for 5 years. We've always been producing and shipping about 920 million tonnes of rock. So it hasn't been an increase in the supply from Australia that's been the problem. It's been the fact that it's increased the revenues. Where the revenues have come from, the fact that the price has gone from 80 to an average of about 180, 200, even though it's down now. And that's produced this massive increase. So on the demand side, a couple of things are going on. First of all, China has urbanized and industrialized about half of its population from the farms into the cities, and they now live in cities built with Australian rocks. And that's been fantastic for our rock diggers. It's been brilliant for dividends and profits. They've lifted 1 billion people out of poverty in doing that in China, which is fantastic. That S curve is now on the top part, we're heading into the top of the S curve, so that massive growth is now stopped, and we're now seeing a slowing of the growth of the urbanization, industrialization. So we're not going to see the great dramatic growth curves we have in iron ore and metallic coal, copper, etc. That's now slowing off. It's still going to be very good. It's still a much bigger pie than it was 5 years ago, 10 years ago, but we're not going to see the growth in
the explosive part of the boom is done. Yeah.
But the steep part of that curve is gone. We're now into the top of the S curve, which is more moderate. So a bit like Japan. Japan grew very quickly in the 50s and 60s and 70s, and they slowed, and their curves slowed off until it basically flatlined after about 1990. So China will eventually slow, and it will stop growing, and the people will get old in the same way, because people haven't, the one-child policy 35 years ago basically stopped growth. So that's hitting now. The growth curves for Chinese steel demand and coal demand and iron ore demand from Australia. So that's on the demand side. The other thing that's occurring is that China's going through normal, every 3 or 4 years it goes through a cycle, a boom and a bust and a slowdown and a re-stimulus again.
Another wave of stimulus, yeah.
We had a bit of a stimulus last year, starting from the COVID crisis into last year. That's now on a slowdown. So you see China starting to try and stimulate activity, stimulate construction to try, which is good for demand, except on the other side of the coin, you've also got this massive clamp down on steel producers, steel production factories in China, and there's every little town, it's very old fashioned, every little town has a steel mill. Just like in Australia, every little town had a flour mill and a brewery. Nowadays there's one or two, and that does it for the whole country. In the China steel, every little town, every little province has a string of little steel mills, which are horribly inefficient, horribly in debt, and pump out all sorts of nasty things in the atmosphere. They're very old tech, very inefficient. Chinese government has been bailing them out continually and throwing more debt and refinancing debt into the never for about 20 years on these, and they are belching out smoke. Why do they keep them alive? They keep them alive because they employ people. Unemployment in China is very low because you've got to keep people happy and compliant. You've got to keep them in work. The last thing you want is to have collapses in every town. And there's steel mills with all sorts of other manufacturing, but steel is really the iconic industrial industry, which employs a lot of people, but it pumps out a lot of gases, and it's very inefficient, and it causes a lot of debt. A couple of China has reached the point now where it's about to say, we're going to let a few companies go broke and into bankruptcy. They have a habit of, these are all state-owned, state-controlled, but I suspect there've been quite a few bankruptcy. So I suspect they're saying, look, we don't want to create this moral hazard of continuing to bail out inefficient steel mills and other industries, because even though it creates employment, keeps people happy, it's got to stop. On the top of that, you've got the carbon emission issue. China's done a very good job of reducing carbon emissions, and one way to do that is to get out of old inefficient factories. So that when they announced, I think on the 1st or 2nd of August, that they would cut steel production, there was a few things going on. They want to cut the cycle of moral hazard in continuing to bail these things out by overproducing. They want to cut carbon output, carbon emissions, which is important. and they want to send a message to all these companies that are run at a loss that you've got to start thinking about making them more productive. So I suspect that a lot of the small town steel mills will be closed. They've been closing slowly over the last few years, but I suspect a lot of those en masse, like maybe a third of them, will close down in the next few months in order to cut emissions, cut output, and that at the same time, of course, China's been trying to cut exports or imports from Australia for other reasons. The only thing they've cut all sorts of agricultural produce, they've cut wine, they've cut coal, they've cut everything. They can't cut the imports of iron ore because there's no better iron ore producer in the world than Australian iron ore from the Pilbara. The Vale mines, the Brazilian mines, are still closed. Brazil was the #1 exporter of iron ore to China, or to the globe, which is mainly China, for years. The closing of that mine in January 2019, which was caused by a tailings dam accident, which killed 300 locals, that's closed the mines and closed the ports. The ports have been closed since COVID. So Australia's done a very good of keeping its ports open, keeping the FIFO workers open, and so far. And you see the results in the WA budget the other day. They're rolling in cash because they kept. So to their credit, the Australian authorities kept the mines running. They kept the ports open. They kept safe. We've got the very low COVID rates in Australia and WA. So that was good. So Australia became, courtesy of those two collapses, Australia became the #1 iron ore exporter to China, to the world in that period. At the same time, you had the South African port, the Durban port, which is the biggest coal exporting port in the world. That's been closed since COVID because of the COVID restrictions, and the Australian coal exporters in Queensland and WA and New South Wales, again, to their credit, kept them open, kept them running. So Australia also became the largest coal exporter. So Australia's done very well.
So the question is then, from here, I guess you're painting a picture that there's been a confluence of factors that have stoked profits to its super normal levels for recent times, but they will go back, but still to healthy levels.
So I suspect there's a lot of things going on both the demand side and the supply side. For example, China's been investing a lot in West Africa. West Africa, Guinea has got some, we think, outside of the Pilbara, the best, richest iron ore deposits in the world on the coast, on a hill near the west end curve of West Africa, Guinea. Guinea had a military coup on the weekend. So I suspect the Chinese money is powerful enough to work through that problem, but it would take years and years to get exports from Guinea of iron ore in the same quality and volume to threaten Australian providers. So Australia's got that problem that up its sleeve. The other side of the coin is that you look at coal and other metals that China's, and also things like agricultural produce that China's restricted for political reasons. Most of that's been taken up by other buyers in Asia. You've got Korea, Taiwan, even Indonesia. So you've got, and Japan, of course. So you've got quite a lot of good demand being picked up by other countries of Australian exports of a whole host of things. All of our Northwest Shelf oil and gas, which is shipped in these giant LNG ships for China, primarily to Japan since the 90s, Woodside and all those guys. China's now taken over as our #1 buyer of LNG. So China has its political aims, but also it's got to be very practical because it needs stuff and it needs cheap stuff and it needs lots of cheap stuff. And Australia's got all that. So Australia's done very well for a whole lot of reasons, partly accidental, managing the way through the process, including the COVID process. Australia's done very well in making sure those revenues and profits stayed up. This obviously, you've got A2 and Treasury wines have got problems, but they're very highly dependent on China. But it's a real lesson to wake up call and say, look, think about the world outside China, which is, China's easy, but all your eggs are in one basket. So that experience taught a lot of companies to look around the world to other markets, including Britain, including Europe, elsewhere in Asia. So India, for example, is buying a lot of things they didn't do a year ago. So far, so good. With all the lockdowns, we can still do deals and negotiate, which is fantastic to see.
Yeah, exports continue to boom. Now, you spoke a little bit in your monthly report about the Afterpay deal.
Yes, well, can't ignore Afterpay. A lot of clients are Afterpay. I missed out on Afterpay, unfortunately. Afterpay broke a lot of records on the Australian market. It was the first company to start from scratch and to go to the top 50, first into the top 20. I think at the time of the takeover bid, it was something like the 15th biggest market value. In terms of market value, which is the number of shares times the share price, multiply that by and add your house number, you get what it was once $50 billion in about February this year. It was the 12th biggest company. Based on, if you rank it by market value, it ranks 14 in the world today, in Australia today.
Yeah.
If you base it on profits, it ranks 2,293rd largest profit out of 2,290.
Classic tech story. Yeah.
The more it loses, it's a tech stock. So the more it loses, the more people say it's fantastic. I've got nothing against speculative tech stocks. Good on them. It also broke the record for the largest ever foreign takeover of an ASX stock by a long way. I think Westfield, Rinka, which was the CSR cement company, all of which was $20-30 billion. But they were those companies. The other companies, I list the top 10 takeovers of Australian companies, and they're all 30, 40, 50-year-old histories of profits and growth, and yet you got Afterpay, which trumps them all with a $39 billion Aussie deal. Never made a cent in profits.
We're going to see Square now listed on our market exposure, so it's going to cause a lot of tech excitement.
Square is Jack Dorsey, who is a legend. He created Twitter. No need to introduce Twitter. He also, on a board day one day, he was sitting in a cafe, and the true story, and he had to go get up and pay his $5 for a coffee or whatever it was. So he said, why don't I just pay on the mobile phone? Why can't you bring the terminal to me and I'll just swipe it? So that idea, when you go and have a coffee or beer or anything else, remember that the coffee and the beer is sitting down coffee. It's one of those museum things. You go, I remember the days we.
I know. I don't give up hope. One day soon, 2023.
Nowadays, your chances are the waiter will bring out, or the waitress will bring out a little machine in a palm, and you swipe your card, and it goes back to the caterer. It goes off to the bank. Chances are they're using Square. So Square is the mobile payment technology which has revolutionised the world of payments. It was invented by Jack Dorsey, the Twitter guy. 5 or 6 years ago. It's been listed for half a dozen years, and I've put the share price chart up. The point about, and it's profitable. Massive revenues are about 20 times that of Afterpay. It makes profits, which Afterpay never has, never will. I never looked like it. Every year it created bigger losses, and Square offered to buy Afterpay, not for cash. So the trick is for shareholders of Afterpay, you're going to have to accept shares in Square and become Square shareholders. Nothing wrong with that. It's a US company. It's a big tech stock. It's in the NASDAQ. Or do you want to sell and pay tax and take your cash in Australia? You could take the cash into US dollars, because it might be, you could take Square listed in US and sell out in US dollars. Or you could take they'll have a CDI, which is a CHESS depository instrument. CDI, it's like an ADR, which basically is your local version of the Square share. It's like Amcor. If you got Amcor, you own Amcor. Amcor sold out years ago. You've now got a bit of paper called a CDI listed on the ASX, which is a bit of paper that represents the Amcor shares. Same as Westfield, Unibail, they sold out, so you get these little CDI. So the question is, you will get either Square shares in the US or Square shares listed in Australia in a CDI certificate which represents Square US. The good thing about that is you can sell it on the ASX and you can get $8 for it. That's the difference. So you get it. I put a bit of metrics around how to decide whether you want to take Square or just take the cash and Afterpay and pay tax. My bottom line is that it was, for every takeover, there's a winner and a loser. Someone pays too much and someone gets a good deal. In all the cases bar one of foreign takeovers of Australian companies, the foreign takeover, the foreign acquirer, long way from home, no DD, good idea, gets out of bed one morning, mostly ego-driven, pays too much. So in 9 out of 10 cases, the company being taken over, the shareholders get a better deal than they ordinarily would. The only exception to that was, I think, Foster's. CUB was bought by UK mob, SAB Miller. they probably got a good deal. Every other foreign takeover, including Westfield was a fantastic company for 30, 40, 50 years. They've paid far too much and it's blown up Unibail, and they've had a sacking of the board and they've written off $40 billion and they're now dumping assets. In every single case, bar one, foreign shareholders pay far too much for local companies. Mind you, it's exactly the same as Australian shareholders going overseas. 9 times out of 10, when an Australian company buys a foreign acquisition, it's ego-driven, you pay too much, you end up writing it off. Look at BHP, look at Rio, look at Westfields with the Bunnings, you look at most takeovers. So most takeovers in corporate history around the world are ego-driven and you pay too much, and none of the synergies are ever realised. That's just a fact of corporate life in the world and in Australia. So my conclusion of this exercise, with Afterpay being a $30 billion takeover of an Australian company by Square, is that Afterpay shareholders have got the much better deal, more than likely, because they're getting, they'll get about a fifth of Square shares issued to them, which is probably double what they ought to based on the relative values of the two companies. So look, talk to your advisor and work out what you want to do. If you're lucky enough to have Afterpay, you've got a choice, and I've got two or three decisions you've got to make. I've got a bit of metrics around the three companies about what to do. So fascinating story. Good luck to them. I didn't buy shares in Afterpay. Unfortunately, I missed out on that one, but there's other things out there.
And finally, just moderate updates on the monetary policy front. Nothing too major, but we had the Jackson Hole Symposium, and I guess a lot of anticipation, but not a lot of updates there. And the RBA also did a slight update in terms of their plans, in terms of the quantitative easing and the scaling out of it.
Yes. So getting back to the first question at the start of today was, share prices are expensive. What's going to cause it to fall? And I've done a lot of work and written a lot about all the crashes in the last 150 years, what caused them, what were the triggers. Markets are very expensive now, but there'll be something out of left field that triggers a major collapse, like we're heading for another tech wreck after that. It's a dot-com-ish boom, it's a pre-GFC type boom, something's got to be a trigger. That doesn't mean it might collapse tomorrow. It could run on for another year or two or three, and there'll be a trigger. The most likely trigger, and there's often a collection of things, but the most likely thing that would have the most impact to cause markets to fall would be a surprise, sudden shift in monetary policy, i.e. rate hikes when no one's expecting rate hikes, or faster than expected rate hikes, or bigger than expected rate hikes. So that's been the case for a while now, since they reduced rates to zero around the world and started accelerating their asset buying programs. So we're all watching the Fed and the RBA. The Fed's the important one, because what happens in the Fed will just follow the US regardless. And I say that facetiously, because if you look at all the crashes in history in Australia, every single one of them bar one was triggered by and accompanied by the US market collapsing. The only one exception was 1951, when we had the Korean War inflation spike and we had a massive collapse, massive tax hike and contraction in monetary policy, and that was 1951. Every other one, Australia just follows the US. Not because we follow regardless, but we're driven by the same things. Global capital flows flow around the world, so they hit Australia. The big one is the US. So when the US is hit, we'll be hit, just like the GFC, just like the COVID crisis. So it will probably be the Fed doing something silly, and it is a long sorry history of doing just that. So the Fed has been saying, look, we're going to keep rates low for a while.
Talking about interest rates.
They had the big meeting in July, and he said himself that was the meeting which we talking about interest rate hikes. So he's laid out a plan, and the plan is really, over the last month, the plan has not changed, which is a good thing. And the plan is really, he said, look, we're going to have to scale out of asset buying, bond buying, the QE bond buying first, which will take probably many quarters, like it did last time in 2013, 14, 15. And then we'll start to raise rates. So we're a long way away from any sudden rate hike plan until we see. I think the scary thing now is people are saying, well, what if he starts tapering? Well, of course he'll start tapering. He said he'll start tapering. Only question is timing. Nothing new. The Jackson Hole meeting was where central bankers go away and contemplate the world and the universe as we know it. That happened at the end of August. There was nothing new out of that. So watch your space. So far, they're going to keep rates low for a long time. We've always thought that there's a lot of reasons to suggest that the Fed and other central banks are terrified of going too hard and too early. They've made too many mistakes over the last post-GFC years, false starts, and they decide to do something that share prices drop 30%. We can't have that. That's bad for everybody. Doesn't make any sense. But that's the thinking, that they won't do an Alan Greenspan. They won't do a Greenspan in '94 and go too early. They'll wait and wait and wait and wait. So meanwhile, share prices won't have that trigger. They might fall for some other reason, but the most likely trigger is an unusual change and a sudden tightening in US monetary policy. In Australia, the RBA had their regular monthly meeting I think on Tuesday this week. Might have been last week. The plan was to, again, same thing, to scale out of bond buying, which is central banks buying their government bonds. The plan was always, or since about middle of the year, the plan was to reduce from buying 5 billion per week of Commonwealth bonds a week, Commonwealth and state bonds per week, to 4 billion per week. So it's a tapering.
Tapering out.
The only difference out of the meeting the other day was he said that don't assume that 5 to 4 billion a week is some sort of regular step down to 3 to 2 to 1. Don't assume that at all. He said, we still have an option to increase it based on what we see in the market ahead. So don't automatically just lock in that in your plan. So that was a good thing. Meanwhile, you've got the more COVID. I think Victoria keeps breaking records. They're going to get close to our infection numbers.
Unfortunately, yes.
In Sydney here, so we're winning so far. So you never know. It's very unknown. So you've got most of Europe now. This Delta strain has caught a lot of people. Europe's now open. You look at
now heading back into booster shots across.
Yeah,
Europe,
so you've
and
got.
the States.
You're looking at the charts, and the world is reporting around about this time last month. The world was reporting about 750,000 new cases per day. That's now down to below 700,000. So the third big hump is now, we're on the other side of the hump, which is good on infections. On global deaths, that third hump, which peaked in about mid-August, that was at about 11,000 deaths a day. That was the third hump this year. We're now down to about an average of 9,000 deaths per day. It sounds like a big number, but it's a 9,000. So the global totals follow a pattern. Most of those are not coming out of the US. Most of those are coming out of India, Indonesia, Brazil. So it's now moved into the emerging market, which are still on their first doses and don't have hospitals and reporting. So it's a different problem for them. The good news, of course, the positive in all of that is the vaccinations. Most countries, most European, US, UK, are into their third jabs. We get the leftovers because we haven't got our first jab yet.
We're getting there.
Australia did a great job in round one, the hard one, but we completely buggered up round two, which is the easy one, which is just vaccination. So a lot of reasons for that. Doesn't matter.
But I guess markets continue to look through it.
I look at profits, I look at dividends, you look at markets, you look at share prices, you look at interest rates, you look at what's happening in the engine of profits, which is companies worldwide and in Australia. You look at what's happening to demand and supply. And barring any, plus also you've got China clamping down on a whole bunch of fronts, including exports and including, they had a classic one the other day. This is all on the People's Daily. They said they were going to ban sissy men, which are male pop stars that wear makeup.
Right.
So if you Google right now, sissy men, China,
Google with caution, please.
Well, they're not making this up. This was the term used. So it's very consistent with the education clampdown last month.
The computer gaming type thing.
A couple of weeks ago, we had them clamp down that all Chinese students under 18 years old can only now spend 3 hours on computer games, down from 143 they currently spend per week, 8 p.m. to 9 p.m. Friday, Saturday, and Sunday. That's it. They can police it and they'll shoot you if you breach it, probably. So it sounds very harsh, but it is consistent with the theme of the great job that the engine of China has industrialized, commercialized, and urbanized this population. It's created this technology, massive wealth they've created for themselves.
They don't want the evils of the West to seep into their society.
Just frittering away, and kids are sitting at home on gaming and Twitter and TikTok and Weibo and what have you.
All the things that you enjoy of an evening.
all the things that my kids used to enjoy. But it is just it's a stance that says, look, Xi Jinping says we're just wasting this great work we've done over 20 years. This wealth is being squandered on cat videos, which is quite true, of course. So how you execute that, how you actually bring about change in a society is very different from a democracy. So that hits a lot of things, including a lot of companies that produce stuff and sell into China. So it's a theme that's not going to go away.
No, that's a multi-generation sort of position they're now trying to take.
You've got the carbon reduction push, which China is at the forefront of, which again affects a lot of industries here. So a lot of the things are going on at once, and we have to keep track of all of those and work out how we sort of adjust our portfolios. Plus you've got monetary policy, plus you've got a lot of things happening, fiscal policy and budget spending as well. So a lot of moving parts, but so far the ship's pretty good at the moment. We still like shares. We did shift our portfolios away from fixed rate bonds into high grade floating rate securities over the last couple of cycles. We've now got almost no fixed rate bonds in portfolios. They're all high grade floating rate. Why that's different is floating rate benefits when rates rise, as they are over the next few years. Fixed rates suffer when rates rise. So we are positioned towards the floating rate side, all high grade corporate floating rate debt, which will do well if and when share interest rates increase, which they surely will over the next
eventually will. Yeah. Excellent. So steady as she goes.
So far, so good. A lot of things happening, but the portfolios, a few changes in portfolios, but basically we're still pretty much happy with the way profits and dividends are coming back to Australia and the world. But we're looking out for some of the changes ahead, and the iron ore price is down, but that's a lot of potential for other buyers of a lot of our natural resources, which are doing every other commodity is doing very well apart from iron ore. So far, so good.
Excellent. And well, the end of quarter suddenly is almost upon us again. So
share price, they've drifted up for the last quarter, which is good. They're up even in Australia. We had a lot of dividends being paid in September. So the share price index for the All Ords is down a couple of percent this month, but the total return index, which includes dividends, is flat. So you got to look past the share price. Fortescue fell 10% because they paid a 10% dividend, so the share price will fall. So BHP is saying, so a lot of companies' share price will fall 2 or 3%, but the total returns, including dividends, is not affected by that.
Excellent. Very interesting as always, and look forward to see what the next quarter brings. Thank you, Ashley.
No problem. Good luck. See you next time.
Thank you, everyone. Thanks for listening.
Bye-bye.
See you next time.